Hello, everyone. Thank you for joining us today for our Lunch with Lou webinar. My name is Jimmy Bassett, and I am an Associate Managing Advisor at AltVest. Today, Lou will be discussing how to navigate the high stock market and the current economy today. After Lou's remarks, I will ask him a few selected questions that our clients have submitted. We expect today's call to last about 45 minutes, and a recorded playback of the webinar will be available should you wish to listen again at a later time. Now it's my pleasure to introduce Lou AltVest.
Hi, folks. It's good to see you, even if it's only virtually. I prefer face-to-face, as you would, I'm sure. Today, I'm going to go over the economy, inflation, interest rates, the stock market, our plans, new thoughts, and I'm going to deal with a little bit the impact of COVID and the Delta variant. Years ago, let me start with a story. It's always good to start with a story. Years ago, I received a referral from my barber. It was a man with $3 million. It turned out he was a real gambler. He bet on the market's direction on borrowed capital and lost. All of his money was taken away by his brokers. That is, all but one stock was seized. That stock was in his vault, and it was left behind because it was, practically speaking, worthless. A worthless technology stock. Then from nowhere, it rose to being valued in the millions of dollars. The owner was nervous and asked me to evaluate it for him because he said he was retired and this was the only stock and the only asset he owned. You could see this is not your average person. So I spoke to a well-known analyst who was wired into Wall Street's thinking on the stock. The analyst told me a Cinderella story of the company arising from the ashes and how well positioned and attractive it was today despite its high valuation. It was a clear buy, he said. I asked him what were the negatives. He said there were none. There were no negatives? Uh-oh. I reported this information back to the investor and told him how nervous I was with a high-priced stock that no one could find negatives about. Why am I telling you this story? Because stocks are high today and many investors only see the positives. For example, one stock, one of the largest owners of motion pictures theaters, AMC, was in terrible shape, headed for potential bankruptcy. They even warned that they would go bankrupt. Speculative interest and the rise in the price led to an equity offering, which reduced somewhat the company's risk profile. They got a lot more money. They could afford to wait until things got better. Nonetheless, the original owner of the stock is said to have liquidated its shares, and the company is viewed today as highly speculative. Did the owner of the Cinderella technology stock also sell his shares? I will go over the result of the $3 million man later, but first let's look at our country's outlook. Our opinion has changed somewhat very recently because of the COVID. Let's start with US GDP. And this part of what I've said is the same as it would have been a month ago, and longer, actually. Let's start. The GDP, if you don't know what GDP is, it's a measure of US production. the largest measure of the total nation's production. It has been on a tear. GDP growth is up strongly, more than twice that of the pre-COVID period. Consumers are ready, willing, and largely able to spend freely. Almost every part of the economy is doing well, or at least better. Keep in mind, many have been benefiting from government spending. Unemployment is down, but part of the reason is many people are out of the labor force and living on government aid. A good portion of these people will have their extra aid run out in September. Very close. Their return to the labor force will help allow output to continue to grow. Those areas of the economy in lockdown, such as entertainment, travel, etc., should add to growth in fourth quarter GDP. Listen to this. This one really is amazing to me. One amazing feat. GDP will soon exceed pre-COVID GDP by so much that output is likely to exceed the amount of GDP which would probably have occurred if there were no GDP over that period. So we've more than made up for average growth. Why? The COVID, or more likely the government aid following the COVID, has had a large favorable impact on consumer spending. Just on its own, the economy should begin to normalize with slower real growth sometime next year. That may mean 3.5% growth for 2022 for the year overall, and a return. That may mean, did I say two? It may mean a 3.5% growth relative to a 2.5% growth at the end of the year. By itself, then, those GDP figures will not justify today's high stock valuations. Let's look at it further to search for added growth or alternative reductions from it. Let's start with Biden. Biden's aid program is one of the keys to extra growth. I'm going to give you my take on Biden. He has three goals. They are all a return to the post-war U.S. environment that he grew up in, and I grew up in, and I still remember that we used to keep our back door open. We weren't worried, at least for the first 10, 15 years of my existence. One, he wants to, what are his goals? He wants to unite the country. That includes both Democrats and Republicans, and for our country to be optimistic as it was after World War II. He wants the middle class, particularly the basic worker, to benefit equally with the higher ups from future growth. In fact, he believes in bottom-up working class strengthening and triggering the economy upward instead of top-down theory of the economy, which starts with the corporation and the wealthiest people benefiting first. The second thing is he wants to take on the China technological challenge by focusing on it, much like our challenge from Russia in the 1950s and 60s in the race to the moon. The third is he wants the US to have clean air and the world to have a clean atmosphere. Biden sees more emphasis on government spending as necessary to bring the working class whites who have begun shifting parties back into the satisfaction fold, even if it creates more debt. Similarly, he wants government spending on technology. His ability to get approval for that spending is, of course, tenuous. A key input will be his ability to get the smaller, narrower revitalization program approved. His overall spending is likely to be reduced, and the tax hikes to corporations and individuals are particularly uncertain. Therefore, U.S. debt will continue to rise. Incidentally, U.S. debt isn't so bad if it rises, as long as it rises in proportion to GDP growth. It's when it gets ahead of GDP growth, as it is for the last few years or several years, that we have problems. Any spending policies could very well be cut off by a few shifts in the Senate or House membership, leading to the loss of Democratic control in 2022. Thus far, Biden has made some inroads and may surprise the pundits. Importantly, any spending boost, even if it's cut back substantially, will add to my 2 to 2.5% growth. And even with the two parties' rancor, is more likely than not to come about. Let's move on to inflation. In the old days, inflation was caused by price increases from commodities. With the exception of oil, price shift from production of goods to that of services has changed the course. 2 of 3 big inflationary contributors, health care and education, have not been problems recently. The third, housing, will be a problem going forward, as housing prices have moved up sharply, although very recently, very recently, they have actually stopped going up. We'll have to see if that's just a summer item, or it is indicating that people have had enough of a price increase to want to wait. But given the government way of calculation, it doesn't even matter if they stop going up. Their way of calculation will be boosting inflation for some time. Now, inflation is more likely to come overall from hikes in wage rates for workers. Those cyclical rises in commodities, particularly oils, still have inflationary relevance. There's been a sharp rise in wages recently due to the shortage of workers. For example, basic shipments of letters and packages are being delayed by absence of workers. I suspect Biden will encourage an increase in wage rates, even if it adds to the inflationary burden. The shortage of semiconductors is a little sneaky thing that gets into many items and has hurt autos and other industries, is likely to moderate gradually and be taken care of in a couple of years. Thinking about inflation, the tapering of the widespread of the industrial shortage, it will be temporary and will, over time, bring inflation down from 6% or higher to, say, 3 or 4. Whether it climbs back up from there depends, as stated, most importantly on, you guessed it, wage increases. Inflation, once started between wage hikes and resultant price increases, could spiral upward. In fact, corporate price increases have already begun. I don't know if people realize that, or maybe you feel it in your spending. Restaurants, for example, are up sharply in prices in New York. Previously, I thought it likely that inflation would increase slowly each year, but not reach the serious level of the 70s, when it was double-digit inflation. Now, because of continuing COVID, high inflation for an extended period is moderately less likely. Besides, the Federal Reserve would engineer a recession, as Chairman Volcker did in the 80s, to prevent a really serious inflationary period. I'll explain why it's moderately less likely in just a few minutes. Interest rates, let's talk about that, a key to the economy. In many ways, interest rates are an important element in the future of the economy and the stock market. The Federal Reserve created the most recent economic rebound and bull market by providing its sharp decline in interest rates about a year ago. Low interest rates made it easy for businesses to borrow and take the appeal out of bonds as an investment competitor. Interest rates have started to climb as the economy turned up a little more than a year ago. Very recently, a strange thing has happened. Interest rates have turned down. Is it due to expectations of a slowdown in the US economy? Is it reflecting easing of money in China? Is it a foreign investor inflows following an initial high rate of bond returns in the United States? Relative high, only relative to the rest of the world, which has rates that are more ridiculously low than ours. An anticipated slowdown in economic growth is the most logical, but we will wait to see whether it's just a temporary aberration. Going forward with rates as low as they are, it's easy to project, it's easy for me to project that in the absence of a real slowdown in the US, rates are going higher. The question is how rapidly. Without a sluggish economy, a continuation of 1.25% 10-year US government bond yields could further increase inflation. A rapid increase in inflation could hurt economic growth. A steady to moderate yearly increase supported by the Federal Reserve, while a negative, would have little effect on the economy and the stock market. The steady type increase is most likely choice right now. The stock market is one of the things that you're most concerned about. The stock market is high. It has been brought up by the optimism in the country, with most individuals no longer being severely tied up to COVID and anticipation of a continuing bounce back in the economy. The optimism is most pronounced for young people who are speculating on the stock market as if it were a video game. As mentioned, if we use consensus projections of a sharp slowdown in economic growth next year, from a fundamental standpoint, there is little upside for US stocks. All we have is current optimism and favorable economic growth at the moment. Relevant stock market factors can and do change the outlook, and surprises are added with some frequency. Let me go over some potential positives and negatives. -1, this has to do with masks and the return of masks. The rapid advancement of the Delta version of the coronavirus has caught the country by surprise. It has reduced the optimism in the country's future already, at least temporarily, by as much as 20% confidence. There's a 20% confidence decline, according to one reputable survey. Going back to wearing a mask or feeling guilty and not doing so may not be consistent with above average household spending patterns. Less domestic enthusiasm is not likely to create a recession, but it could moderate the economy's future growth. A more sober view of the future could make the economy more vulnerable to a significant decline, particularly if it is accompanied by other negative news. All right, -2, a rise in inflation. If, in this scenario, current inflation does not turn down, instead promises to continue to rise, the Federal Reserve is forced to tighten and thereby creates the possibility of a recession. Potential positive. For this scenario, let's assume that Biden is able to get a substantial portion of his spending program through without triggering higher inflation. The way it is structured, it could add to normal economic growth and create above average profit rises for many years. This could allow the stock market to be justified in its current stock valuation and allow stock prices to go up from here. All right, let's talk about investment changes. On balance, we have taken a position to allow us to participate in any further rise in the U.S. stock market, but with some hedging characteristics so that we can cushion somewhat any decline in the market. At the same time, we have above average positions in foreign stocks whose valuations are much lower than in the United States. Did you know that U.S. corporate profits have doubled since 2008, while the European Union profits have not grown at all? That's crazy. That's like 13 years of no growth abroad. A continuing strong economy abroad will allow corporate profits and stock prices in developing and developed markets abroad to well outperform the U.S. We have brought our risk profile down somewhat by increasing our equity hedges. We have also added to emerging market positions and the purchase of a U.S. real estate technology-oriented ETF. We expect to add to our cyclical stocks orientation at the time the economic outlook clears for them. Finally, we are examining whether China's technology companies have become attractive after their underperformance caused by their government's closer supervision of their operations. As a matter of fact, I'm going to be involved in a discussion on this later today. Let's get back to the original story about the one stock in his portfolio guy, the $3 million man. Knowing that he was an extremist, I said to him, given Wall Street's lack of negatives and high valuation, I am afraid of a massive correction. So sell a half a loaf of the stock. You say, why did I use that expression? I used the half a loaf phrase intentionally to try to reach him for what really should be, he should have a diversified portfolio. He listened carefully and said when the stock, then selling at 40, reached 50, he would sell. Actually, it reached 50, but he didn't liquidate and rode the stock down until it again sold at an insignificant price. Not a happy story, but one that underlines the dangers of going along with the crowd, not to mention the benefits of diversification and contrarian thinking. Let me summarize my points, my thoughts. The outlook for the economy and for stocks today is most affected by COVID and consumer desire for spending. The growth of the Delta variant may have set back consumption enthusiasm, but will probably only moderate growth somewhat in the economy, particularly if President Biden's spending program still has legs. If he can develop a strong government spending program, the economy and the stock market can continue to grow strongly and could cause some further inflation problem, as I mentioned before. If growth returns to just pre-COVID levels, stocks have a great chance for a significant downside at some point. In any case, look for more volatility in stocks going forward.
Thank you, Lou. Now we'll address a few questions that our listeners sent in. First question we have, Lou. The high stock market has generated high unrealized long-term capital gains. Is it advisable to cash in and pay the capital gain tax?
The only reason to sell, the major reason to sell now is if stocks or particular companies you have look like they're fundamentally unattractive. Now, there's another reason. I don't know how much weighting you want to put in this, but Biden has said that he wants to raise taxes, and that would take effect next year or the year after. That could create a reason, but is it likely? Of all of his program, the least likely portion is that of raising taxes. That's like an uncomfortable item for both Democrats and Republicans.
Thank you, Lou. Our next question, I think,
Let me just say, obviously, maybe I should just say that increasing taxes would mean potentially, if you were going to have something that you were going to sell next year, it would be a good, if that were to come about, it might be more favorable to sell it this year.
I think that's a very good fine point to put on that. Our second question hits a little more closer to home. How has COVID affected New York City's plans for the future?
So far, so good. There has been some movement out of the immediate area, but thus far less than expected. Prices for houses have not declined, and rental rates have not been hurt materially. Many of the people who have moved have maintained themselves within its suburban area. The prior fear of COVID, when New York was the big carrier, had its epidemic been replaced ever since then by other people who have COVID. So why pick on the U.S.? Even the geographic areas that didn't get hit originally are getting hit more often now.
I think that's a very good point. And next question, also related to COVID. Has COVID altered shopping habits?
Yes, it is likely that people will continue to be doing a greater and greater portion of their purchases online as opposed to being in stores. Even in fresh produce, locally, Fresh Direct and other national chains are providing competition. I just received a coupon for $50 off my first purchase at Fresh Direct of if I spend $100 or more. Now that's a significant item.
No, absolutely. All right, for our next question, back to the markets. Why have the large technology stocks been up and down this year? Isn't it true that their earnings are fairly predictable and growing at above average price or above average pace?
Yes, technologies are growing at an above average pace. Their predictability and profit growth makes them investor favorites, especially when the economy is expected to be weak and are exchanged for cyclical stocks when the outlook looks like it's going to be strong and have cheaper stock prices. Projected faster economic growth prospects make cyclical stocks more attractive at that point. These big companies that are taking up a large portion of technology, and some say are stifling competition, may run into problems in Washington, in which many legislators of both parties want to break up or otherwise put controls on them. Obviously, this is a possible future problem for them.
Thank you, Lou. And I think we have our last question here. Why have interest rates declined recently while the stock market has continued to move up?
I could be what my son's favorite question was. He's now the president, but he for an answer like that, he might say, beats me, but I'm going to give you my best thought. You're right. The two moves are inconsistent with each other. The bond market is saying through the interest rate drop that there will be a slowdown in the economy, maybe caused by the Delta variants, while the stock market disagrees and says the economic outlook is favorable. The stock market has not, after blinking for one day, it hasn't really had a difficulty. Something has to give. A rosy future outlook would bring about a resolution of that. It would bring about a rise in interest rates.
Well, thank you, Lou. I think that's all the questions that we've had. And thank you to everyone for joining today and for sending us your questions. In case you joined today's webinar late, or if you would like to pass Lou's remarks along to a friend, we will be posting a replay of the webinar on our website, and you will see an email once the replay is available. And of course, if you have more personal questions, please contact one of your members at AltVest Wealth Management on your AltVest Wealth Management team, or you can call our office directly at 212-406-0850. Once again, thank you for joining Lunch with Lou, and have a nice day.